Today we are going to start a topic is type of mutual funds. And why this topic is important for us, guys, because whenever we are going to invest our money, so this is the practical glimpse of this. You can see there's so many types of mutual funds, so many types of mutual funds. We have a lot of diversity in mutual funds. This is Zerodha's, site. So there's so many types of mutual funds. We really need to know where to invest, which type of mutual fund is better, what returns we can expect from the mutual fund. So that is why this chapter is very important to understand. So guys, let's start from the topic again. What was mutual fund and how it used to work? We had completed this in the previous module as well, but still, let me remind you first of all. Mutual fund is pooling of money from public and using that money to invest at a specific security. Or it can be said in different way. People pool their money, give the money to an AMC or fund manager, and that fund manager is a very learned person, very experienced person, having a good background in and expertise in investment banking, finance. So he invests that money on your behalf. So the benefit is that you don't need to have good knowledge. You don't need to have, you don't need to invest a lot of time. The entire time and entire expertise is used of this fund manager basically. So he is the man who decides everything. But guys, before we invest our money, we have to decide what type of mutual fund we should be investing our money in because there's so many types of mutual funds in the market. So we need to understand, what types of mutual fund, how many types of mutual funds are there, how they work, what are the returns basically, so that these investors they shortlist at least a good mutual fund. So once a good mutual fund is shortlisted, then your job is done. Your job is just one that you have to shortlist a good mutual fund. Rest, where the money is being invested, what are the returns, everything is handled by this fund manager. So it is just one-time activity, guys. In stock market, in equity market, once you're buying shares or stocks, you have to do research on day-to-day basis. It's very active process. But in mutual fund, the research part is very less, and you just have to do it once. Once it is done, then you have to keep investing your money. That's it. You have to stay. You have to keep holding on for a long period of time. Once you can stay there for a long period of time, it is a guarantee that you will be getting good amount of returns from the mutual fund. So the thing is that, guys, the mutual funds are they're so diversified that we need to understand what type of mutual fund would be better for you. What type of mutual fund would be better for your needs, basically, right? So the thing is that the mutual funds are basically divided or are basically characterized by this process only, means where this money is being invested by this fund manager, means the money which you had given to this fund manager, where this money is being utilized. This is type 1 diversification, means where this fund manager is parking your money, where this fund manager is using your money basically. First type of diversification. Second type of diversification would be how these people are investing in this fund, means are they investing day-to-day basis, are they investing once, or are they investing, is there some lock-in period? So there is some characteristics how the money is being invested and how the money is being parked, means how people are giving money to this fund manager and how this fund manager is using the money. This is how the mutual funds are diversified. This is how the mutual funds are characterized. So these are just the two ways. And there will be further, diversification. There will further classifications of the mutual fund based on these two things only. How these people are giving money to this AMC or fund manager, and how this fund manager would be using the money. So in this picture, you know, the diagram wants to convey that how the funds are utilized, means are the funds utilized in the most optimized manner, most effective manner, or are the funds utilized in the most rash manner or most risky manner? So those things we need to understand. This is something we need to learn in the research. So this class is not just going to be a theoretical class. We are going to apply the concepts into practical manner as well. So we are going to learn and apply at the same time. And in the next and the last class, we are going to do complete practical stuff, 100% practical. Now, this is how there should be a best optimum use of the funds which were given by these investors to the fund manager. He should be a wise man, he should be a learned man, and he should be a good logical man. So better optimization, better use, effective use of the funds takes place. So now let's see how the mutual funds are classified. So mutual funds are classified on the basis of structure. Now, for example, open-ended, close-ended, and interval funds. Mutual funds are also based on investment objective, means where the fund is being utilized. Debt funds, equity funds, and hybrid funds. Then next comes based on investment style. Mutual funds are also based on investment style, means passive funds and active funds. Now let's start from step by step. Let's start from the very basic and let's apply the practicals only straight away. Now we'll start from here itself. Now if I ask you that, okay, Mr. Ram, Mr. Ashok, let's invest our money in mutual funds. Guys, the name of website is Advisor Coach. This is completely free. It's not an advertisement for this website. Anyone can use it. There is no need to log in as well. Just use it for the research. Tomorrow, I will be giving you one more website for the research part only. All right. Secondly, one disclaimer that whatever being discussed in the class should be used for educational purposes only. It should not be used as investment advice. Right. Now, number one, you might have seen if, for example, you as a working employee or you as a student, my class student, you must be having some money. And if I ask you, let's invest the money in mutual fund. First thing that will come to your mind, how to approach a mutual fund. So there are two ways, guys, direct and regular. Direct means, let's discuss the regular part first. What you will do, you will go to a distributor, but there must be a distributor near to your hometown, near to your house. You went to a bank, and the bank manager, he tends to sell a mutual fund to you, that sir, this is a good mutual fund and you should be investing. But guys, over here the thing was that that person, the broker, the commission agent, he will be charging some commission, he will be getting some commission in between. I hope you're getting the point. In yesterday's class we had seen the expense ratios. So AMC charges expense ratio. Number two, the person who is selling you the mutual fund, that person will also charge commission, not directly from you, but whatever money you will be investing, he will be, the money will automatically get deducted. Now, don't you think that, that will hamper your returns? Means one thing that will be hampering your return would be the expense ratio charged by the mutual fund company, charged by the AMC. Number one, that is unavoidable, that you have to pay. But if you are buying a mutual fund indirectly or by a regular basis from a broker, from a distributor, or from an agent, that person has a commission in between. So you have to pay that person as well. So it will be shared again from your profits only, right? Now the thing is that it is now being a finance student, it is advisable that you should buy mutual fund directly. Now there's so many websites, guys. For example, this is Zerodha. This is Coin uh, launched by Zerodha itself. You can buy mutual funds directly from here, so you don't have to pay the commission charges. But the thing is that, guys, in India and worldwide as well, 55% of the market share of mutual funds are in the hands of brokers only, in the hands of distributors only, and it's a good career for you as well. So you can also become a distributor. You have to, give an exam of an ISM. So whatever we will be discussing in next two classes, it will be more than sufficient for that exam. Now you too can become a distributor of mutual funds. All you have to distribute or sell the mutual funds, and you will be getting a regular income, yearly income, whatever people will be investing in those mutual funds. So this is called as a regular. Regular funds are those funds, guys, which you buy indirectly or which you buy from distributors, commission agents, or a broker in between. And for this, you will be paying some money. That money will be automatically deducted. Second type of mutual fund would be direct. This direct mutual fund would be you are buying the mutual fund directly from the company. So the commission charges of that broker part is removed. So it is a good way. One more thing over here is that which one is advisable. If you are an investor, it is advisable to go for direct funds. You will have more returns as compared to regular. But if you are trying to earn some extra money, if you want to start a business, so if you want to start a company of selling mutual funds, then for you, regular mutual fund is good because you will be selling more and more mutual funds and you will be earning more and more commissions. So this is how it works. This is step number one. So now this is clear to you what types of mutual funds are there in terms of buying, how you can buy a mutual fund. So it could be direct mutual fund, it could be regular mutual fund. So advisable is that you buy direct mutual funds. These are more beneficial and you get more returns as compared to regular mutual funds in direct mutual funds. So this is the first thing that how you are purchasing mutual funds. I hope this is clear to you. Now, open-ended mutual funds, interval funds, and close-ended mutual funds. What exactly they mean. Now, guys, in this picture I had given you the classification is basically on two bases. How these people are putting their money in this mutual fund company or AMC, and how this fund manager is utilizing the money. This is the only way of classification. Now, if these investors can invest anytime, can redeem anytime, right? So if these investors, uh, if I am investing today and next month I want to take my money back. If I am investing today, after 2 years I want to take my money back, means there is no as such lock-in period over here. Such kind of mutual funds are called as open-ended mutual funds. Open-ended in the sense there is no lock-in period as such. There is no fixed maturity date. You can enter any point, you can exit any point. What about exit loads? We had discussed in the previous class. Yes, there would be exit loads. There may or may not be. Sometimes exit loads are there, sometimes they are not there. But even if they are exit loads, still you can exit any point of time. You just have to pay some penalty. There is no lock-in period as such. So open-ended, that is why the name itself is suggesting that these are the funds where entry and exit are free. Entry and exits, there are no foundations on that. You don't have, nothing, you're not obliged to stay there, or there is no lock-in period as such. So there is no maturity date. They accept the continuous sales and repurchase of the request. Means you can buy it today, you can sell it tomorrow, you can again buy it after some time, and you can again sell it. So there is no entry and exit barriers over here. Now, it is based on the NAV, that we had already discussed in the yesterday's class. NAVs are calculated on day-to-day basis on the day end. Sometime on some mutual funds, they have, weekly NAV calculations as well. So this is how you are buying a mutual fund on the basis of NAV and you get units in the return. So guys, if these people, they are investing their money, they're pooling their money and investing their money over here at any point of time. And if someone out of these, they need their money, they can take their money back any point of time. Such kind of, mutual funds, which are quite liberal, they don't have any lock-in period. Such type of mutual funds are called as open-ended. They are open for everything. And they're long-term, guys. These mutual funds are quite long-term mutual funds. So let's see how it is relevant over here in the website. So for example, equity, large cap, let's see this one, direct, submit. So if I see over here, guys, there will be some mutual funds who will be open-ended. There will be mutual funds who will be close-ended as well. So let's click on Nippon India Large Cap Direct Mutual Fund. So I hope you are getting the point. Now, direct means this is you are buying directly from the company itself. Let's see. Let it get opened. In the meanwhile, guys, I hope this is clear. Now, what is closed-ended mutual fund over here? Now, closed-ended mutual fund is if I compare it, I can compare it with an IPO, for example. So similarly, initial public offering of a company in stock market. So there is fund opening as well, right? So a new fund offering takes place just like an IPO, and you can invest in these mutual funds only at the time of those openings, only at the times once they are issued. Let me repeat myself, guys. For example, I am a company and I want to raise money from equity market. So what I would do over here, I will go to stock market, issue IPO. And that IPO is issued for the only once in the stock market. So for me, it is once a lifetime achievement or experience being a company that I am raising money from. It's very important phenomenon or event in a company's timeline. So people can invest in IPO once, only once. Similarly, the closed-ended mutual funds, they are you can invest in these mutual funds only when the new fund offering takes place. Once the new fund is being started. So there is a start date of these mutual funds. So for example, I am starting this kind of mutual fund. So I will keep a specific date. Just for example, today is 21st of December. So I will keep 10th of January, the last date of investments. So before that, how many people wants to invest? As many number of people they wants to, they can invest only till 10th of January. But after that, the dates will be closed. No investments after that. So once you had given your money to me, there will be a lock-in period, guys. That is why it is called as closed. Now you can't withdraw your money. You can't withdraw your money for next 5 years or 10 years. So there will be a lock-in period, just like PPFs. So once you invest your money in PPF, your money will stay there for 15 years. Same case, closed-ended mutual funds are the funds where your money will be parked and there will be a lock-in period. Now I took your money and until and unless there is a maturity date, I will not give the money back to you. The money would be given only once the maturity dates, takes place, and you can't withdraw in between. So there is no frequent buying and selling. There is no exit. So it's just once. Entry is once, and exit is also once. So it you can enter only once, and you can exit only once. So there is no in between redemption. So here was the example, guys. So Nippon India large cap direct plan. Now I hope you know the meaning of direct over here. Direct means you're directly buying this thing. And over here you can see see status. Status here shows open-ended schemes. So this is a open-ended scheme. So it started first 2013. So it started from 1st of January 2013. Since it is open-ended, so you can invest anytime and you can withdraw your money any point of time. Yes, there is exit load over here, but if I tell you that you can invest any point of time. On contrary, if this would have been a closed-ended mutual fund, just I'm saying, if this would have been a closed-ended mutual fund, just imagine, so person would have invested his money at this point of time, 1st January 2013. And after this investment, the person, the people, and all the investors would have not allowed to invest again. Second, there would have been some lock-in period. People can't withdraw their money. They can withdraw the money only after a specific time, after specified lock-in period. So that type would have been called as direct that closed-ended mutual fund. I hope this is clear to everybody. Now, next is interval funds. Interval funds, as you can see, it is having the characteristics and the traits of both combined. So these are closed-ended mutual funds, but they open in between. Means, for example, in close-ended, you can enter once, exit once. But over here, there will be some intervals. Means if there was 10 years of mutual fund, so it will open after every 2 years, after every 3 years, for example. So you can withdraw your money after 3 years, and you can reinvest your money after 3 years again. So there will be some intervals, pre-decided intervals, so that you can invest your money again over there. So this is how these funds work. So which type of fund is beneficial for you, if you ask? Though we are going to discuss in the practical class as well. See, open-ended mutual funds are good for those people who have, who don't have, who wants to invest any point of time. They don't have a fixed agenda. Closed-ended mutual funds it is better. Sometimes it gives better returns as well because there is a lock-in period and the fund manager get good amount of time to think, good amount of time to invest the money. So closed-ended mutual funds give sometimes better returns. So these are beneficial for those people who don't have to worry about redemptions. They just invest and forget the money. So these are also good. Open-ended are also good for those people who don't want to have a rigid system of investments. They want to be flexible. So such kind of mutual funds are open-ended mutual funds. I hope this is clear to everybody. Now, passive and active fund. Now, as I had told you guys, now the money is given to this fund manager. Now, this fund manager can use the money the way he wants. He can invest the money in risky assets because, see, guys, you had trusted this man, and that is why you had given your money to this person, basically, right? So, this man can invest your money in bad assets. This man can invest your money in less risky assets. This man can invest money in passive assets as well. So, let's see what passive means. See, this man is having 35,000 crore rupee. Over here, see, AUM was 35,000 crore. It's huge, huge amount of money. See, total assets are of 35,000 crores. Now, guys, this person can invest that 35,000 crores in those companies which are very risky and which can give more risk, more returns, right? But if he's investing the money in risky assets, he has to do a lot of research. So these types of mutual funds are called as active mutual funds, where he has to be involved actively. Actively means every day he have to do the research. Every day he has to, see what's happening in the stock market. Every day he and his team has to, keep checking the portfolio, what is happening. So this is active fund. Active funds, it is highly stressed environment, highly dynamic environment. Buying and selling are taking place on day-to-day basis. So this is active fund, basically. Active involvement of fund manager is required. There is second fund as well, that is passive fund. As the name itself suggests, you passive. And this person, this time, he wants to live a relaxed life, no tensions at all. What he will do? He will take 35,000 crores, right? And he will invest your money in indexes straight. Indexes we had discussed in the equity chapter in the previous class, guys. Indices include top companies of a country. For example, let's take Nifty 50. So in Nifty 50 is an index of NSE, right? So he will be investing 50 top companies of the country. Straight away, he will take 35,000 crores and he will invest 35,000 crores in top 50 companies in proportionate level according to the weightage of those 50 companies. That's it. Once it's done, he will sit relaxed. That's it. His job is done. He don't have to do active research. He don't have to be very dynamic, seeing the portfolio again and again. Just invest the money in top 50 companies. Good to go. Same thing you can also do, guys. If you don't want to invest your money in the mutual funds and you have some amount of cash, invest in the top 50 companies of the country, in Nifty 50 companies. It's you will get good returns, and you don't have to pay the expense ratio as well. You don't have to pay the commissions as well. Directly you can invest in stocks. But mutual funds are beneficial for those people who don't have the knowledge of stock market, who don't have the knowledge of investments, and who don't have the time basically. So active funds are those funds who uh, in which involve management of cash on day-to-day basis. Actively manage the allocation to the market and the security and the cash. He is performing every day. He has to perform, he has to do his job, he has to do the research on daily basis. So this is active involvement is required, right? Now it incur higher costs. Why the higher costs are there, guys? Because you need to have good amount of team with you, people working along with you, because very if the markets are so dynamic, every day you need to do the churning of your existing portfolio, then you need to have active team members who are working every day. You need to do research every day. So commission charges are quite high in active. So expense charges are quite high in active. Passive funds, they just replicate the market index, as I told you. No tensions at all. That is a passive fund is given. And the passive investments, even you can also do. There's no need to, see your portfolio every day. Just invest in top 10 or top 20 or top 50 companies of Nifty. That's it. You're good to go, guys. You can earn better returns than mutual funds. So, but the thing is that right entry and right exits, they need some research. So that is something people, if they are unaware of technical charts, they are unaware of fundamental analysis, it becomes difficult for them. So there is no active selection of any stock. Expense ratios are also lower. They invest in same securities, in same proportion of that of the index, as I told you basically. So the thing is that, and the portfolio is not modified every time. Over here, the portfolio keeps changing. Over here, the portfolio stay more over same portfolio stays at least for 5-10 years because Nifty 50 companies they rarely change. And if there is a change in the company itself, so they sell the shares stocks of those company and the new company who is getting into Nifty 50, they will be buying the share of that company. So this is active fund and passive fund. I hope this is clear to everyone. Now, this one is very important, guys. Equity fund, debt fund, and hybrid fund. What are they basically? Now, this is quite interesting thing, guys. People do get confused in this thing only, which mutual fund they should be investing. Now, at least one thing is clear: invest in direct funds. Second, invest if you want easy returns, invest in passive. If you want higher returns, invest in active. Active are a bit risky, passive are less risky, but returns are stable over there. Now, as I told you in the previous slides, this fund manager is taking money from all of you and investing that money in the securities. All right. If this fund manager is investing your money in equity, only in stocks. So that becomes equity fund. He took your money, purchase stocks from that money. That is called as equity investment. Now, second type, he took your money, invested your money in bonds, not in equity, not in stock market, but in bonds. So this is called as debt market or debt fund, right? Again, he took your money, invested some of the money in stocks, some of the money in bonds, some of the money in commodities as well sometimes, or in real estate as well sometimes. That is called as hybrid fund because he's using your money and mixing securities, he's buying mixed securities. So let's see. Equity funds, they invest in equity. As the name itself says, where the money is being invested, that is something we have to see. So they are investing the money in equity, right? In stocks. They are buying the shares of the companies. More returns you will get from equity, but there is more risk in equity as well, right? Now, if he's taking the money from you and invests your money in bonds, that is called as debt fund. So investing your money in debt instruments. Returns are quite less over here, guys, because the risk is quite less. Now coming to hybrid. Hybrid is the middleman. You know, it comes between both of them. They combined, they take the money from you and invest your money in debt or in equity or in some other things like commodities or some, foreign exchange, or you can say real estate as well. That is hybrid. Means it is a mixture of multiple things. Now, moderate returns and moderate risk. Guys, over here there is a riskometer, if you can see. So low, moderate, high. This riskometer you will be seeing in all the mutual funds. You will get to know which mutual fund is giving you how much returns and how much risk is involved. If the risk is high, so obviously returns would be high. If the risk is low, obviously returns would be low. Might have heard the statement risk hai to ishq hai, something like that. So it means that more risk, more returns, but more chances of losing of money as well, right? Now, how it is relevant in the practical thing? Now, guys, just see. Oh my God, so many types of mutual funds, insanely so many types of mutual funds, and people do get confused over here. Now, we're gonna discuss all these mutual funds one by one. So before we proceed further, I would like to highlight one thing over here is that this riskometer, we will be seeing this riskometer as well, how it is relevant over here. Now let's start our journey from children funds. This, see guys, there's so many types of funds. Children fund, retirement fund, tax saving fund, debt fund, equity fund, international funds, funds of funds. It's just like there's so many types of chocolates in the market. You can have anyone, whatever you like. There are so many types of mutual funds in the market. Invest whatever you like in. So it really depends what are your likings basically. Let's start from children fund. Children funds are funds, guys. which comes with a lock-in period. It comes with a lock-in period of 3 years, right? You can withdraw the money sometimes, but the thing is that it comes with a lock-in period of 3 years. So there's so many types of, see, children funds. So whenever, so these are the returns, yearly returns. So return part we are going to see in the practical part, which we are going to start tomorrow. So these are the returns. So if I click over here, let's see what it says. So one more thing over here, guys. Whenever you will be clicking on the any mutual fund, it will come see holding period less than 3 years. There is a lock-in period, right? So if you withdraw your money less than 1 year, 3% expense charge would be there. If you withdraw your money less than 2 years, 2% charge. If you withdraw your money less than 3 years, more than 2 years, and less than 3 years, then 1% charge. So it comes with a lock-in period, at least a lock-in period of 3 years, basically. Guys, over here, when I scroll down, you can see the riskometer. See, over here, there is a riskometer. So this riskometer would you will find everywhere, almost everywhere. In all the mutual funds, this diagrammatic representation is given. So risks are high, so obviously returns are also high. So once we'll scroll down, guys, we will get to know where this mutual fund is investing your money, portfolio. So this is again, let's this websites get open. In the meanwhile, so this was type of mutual fund, and this type of mutual fund invests in. So let's see asset class. What is the asset class of this mutual fund? It is mixed hybrid. So it means it is investing in all the mutual fund, all types of securities. It is investing in bonds, equity means shares, as well as other instruments as well. I hope this is clear to everyone. Okay, now over here, if I scroll down, guys, okay, there must be some. Huh, here it comes. All the mutual funds, they give allocations, guys, and you can see this allocation. Now, one more example which I can tell you over here is that, guys, find out. This is again a practical tip to all of you. Find out top performing mutual funds and find out where they are investing their money, in which companies they are investing their money. So this person, this mutual fund, this asset manager is investing his money in TREPS. It is investing his money in Muthoot Finance. These are the companies. So this person is investing his money like this. So you can shortlist few companies, shares, name of few companies like for Shakti Pumps, Renew Energy, Brainbees Solutions, and then you put your own research. And instead of investing in mutual funds, why don't you buy shares of these companies itself? So if this mutual fund had invested its portfolio, his money in these companies, for example, TREPS we are going to discuss afterwards what it means. But if this mutual funds had invested his money over here in these companies, why don't you invest directly in shares? This is again investment advice that find out the top performing mutual funds of India and find out their portfolios. That's it. You're good to go and invest in those shares. But before investing, do your own research. Huh? Combine your own research and find top five companies, list name of companies of top five mutual funds. There must be some common companies. And once you find those companies, you can invest in these companies. So this is called as children fund. And this the page would be similar for all types of mutual fund. It will be we will be discussing this page by tomorrow when we will be doing the complete practical stuff. But right now we will be seeing it is open-ended, asset class is mixed. Once we'll scroll down, we can see the asset riskometer as well. If the risk is very high, it means chances of making profits are also very high. Chances of losses are also very high. Then you should and you must see where this company is investing the money, right? Now, coming to the next class. Now, debt funds. Guys, debt funds are not advisable to invest. Why I'm saying this? See, as such, all the market instruments are good. It's not like that this instrument is good and this is bad. All are good as per the needs of the people. But debt funds have less returns. Let's see. Debt fund, bank, how much returns we can get from here and how much return we can expect from here. Okay. So over here, what is happening? Debt funds you can expect around 7 to 8%. Sometimes it touches 10% as well. But if I tell you guys, inflation rate is 7%, and you are getting 7% return from the mutual fund, then it is not advisable. Now let's see. The same thing is here in this is Zerodha's website. The same thing you'll find over here. So this is debt fund. Let's open overnight banking PSU funds. So if I click over here, banking PSU fund, so let's see how much return you can expect from here. So over here, see guys, we are expecting this is the return 8%, 6%, again 6%, and since launch 8%. As I told you, you can expect in all the debt funds, you can expect a return from ranging from 6% to 10%. And inflation rate is 7%, guys, right? So it is not that much advisable to invest in debt funds because the same returns you will be getting from FDRD, same amount of return you will be getting in PPF as well. So why to take risk? I hope you're getting my point. Now let's click on any one of these funds. Now, one more thing I would like to tell you guys, we should always expect returns higher than the inflation rates. That is very important. Now, one more thing that I would be highlighting over here, guys. The debt funds have some risk. PPF comes with zero risk. FDs, RDs, they come with zero risk because they are banking instruments. This is investment instrument. Yes, there is a kind of risk involved over here. And even taking risk, you are getting 7% or 8% return. Then I don't expect that you should be investing, being investment banking student, you should be investing in debt funds. Only thing why you should be investing in debt funds, if you have huge amount of money, then you should invest in all the instruments. Use a debt instrument, FDs, RDs, PPF, put your money everywhere. But if you are wise and you want to use your money wisely, then it is advisable not to invest in debt funds because the returns would be again around, as I told you, 7% to 10%, ranging. So in major cases, it will be landing from 7% to 8% only. Now, let's see what types of debt funds are there. Debt fund banking means the fund manager would be buying the bonds of banking and PSU. Debt corporate, so the fund manager would be investing your money in corporate bonds. Credit risk debt funds means he will be investing your money in risky bonds. Over here, the returns would be higher because it is risky. So even it is risky, you can expect a return of 10%. But guys, if you ask a question that, sir, is there a chance of default in mutual funds? Is there a chance of losses in mutual funds? The answer would be yes. The best example, and this is a case study, and I would like you to explore this. Franklin debt funds, around 2020, they defaulted. It failed, basically. Debt funds are less risky, as I told you, but still it failed. So they were investing in risky bonds. So if you are your money, because what happened, they were buying bonds and bonds of the companies, and the companies defaulted. Means if I am investing my money in a manufacturing company in bonds, the company is not having money to pay, and the investors' money it got stuck because now being a AMC, I was unable to pay their money back. I hope you're getting my point. So they invest the money in risky bonds, so you will have higher returns, but around 10%, not advisable as such. Dynamic bonds means they will be changing the portfolio again and again. They will be investing in multiple bonds. So that is why the name dynamic is given. I want to tell you one more thing. It is open now. See the riskometer, guys. In equity bond, riskometer was very high. Over here, it is moderate. So if it is moderate, guys, you can expect less returns because risk is less. So expected returns are also less. And this was the CAGR since inception, 8%. So inflation is 7%, 8% returns you are making from bonds. So it's not advisable as such, right? But again, uh, if someone asks you a question, which fund is better, depending upon the needs, all the funds are good. Floater funds, as the term itself, it will be investing your money in the funds, in the bonds, which are having floating interest rates. So again, on an average, you will get 7 to 8% only, but they are investing your money in the bonds which they will get returns or interest in the floating manner, means changing manner, dynamic manner. Guilt. Whenever this world guilt will come, it means they are investing your money in government bonds. They are more secure. They are better than all these, right? But again, if they are secure, returns would be less. So instead, you are investing in gilt funds. Why don't you directly invest in sovereign bonds? Why don't you directly invest in government securities? That is also a good way of investments. Over there, you can expect around 10%. But over here, you are buying funds. Second, you are paying commission as well. So the thing is that your returns will get low. So debt gilt fund when your money is being invested in government securities. Dealt gilt funds with 10-year constant duration. Again, they are investing in government securities with 10-year uh, dates basically. But over here, since these are open-ended funds, you can invest and redeem any point of time. Not an issue. Debt liquid funds means they are investing your money in money market instruments, money market bonds. Again, government securities. That long duration, they are buying bonds for long durations. That low duration, they are buying bonds for low duration. Sometimes overnight, bank do these kind of transactions, overnight transactions, day-to-day basis transaction, weekly transaction on the basis of on the exchange of government securities and bonds itself. So these mutual funds are buying the bonds of less duration, medium duration, and long duration. Money market, as I told you, overnight, as I told you, short duration, as I told you, ultra short duration or overnight bonds. Now coming to equity. Now I hope this is clear, guys. Debt funds are those mutual funds who invest your money only in bonds. It could be government bonds, corporate bonds, overnight bonds, money market instruments, anywhere. Returns expected would be 8%, around 8%. It could be 7, sometimes 8, sometimes 9. Rarely it will touch 10, but if it is touching 10%, the bonds will be risky. So not advisable, really not advisable. Now, equity. As I told you, if the fund manager is taking your money and investing that money in stocks, then that kind of mutual fund is called as equity mutual fund. I hope this is clear. Contra mutual fund. Let's start from here, guys. So I hope this is clear to everybody. This was the riskometer over here. This was for debt mutual fund. And fixed asset class is fixed income. Fixed income is a term used for debt market only. We are going to discuss fixed income securities in the coming classes. So I hope this is clear to everybody. Now coming back to okay, PSU equity fund. Now let's see equity. In equity, now the first question that should be coming in your mind is, so what are the returns that you should be expecting from equity funds? So the returns that you should be expecting from the equity funds could vary from 18%, could vary to 20%, could touch sometimes 30% as well. But on an average, it's 18 to 20% return. So if inflation rate is 7% and you are making a return of 18 to 20%, it's a good thing. But guys, all the equity funds would have very high risk or high risk. Because they are having very high risk, you will be getting high returns. Now, if the fund manager is investing your money in risky companies, small companies, right? The risk would be high, return would be high. First thing. If the equity fund manager is investing your money in blue chip companies, large caps, basically, risk would be less, but returns would be stable. Stable in the sense not very high, stable returns you'll get. So if you invest your money in big companies, risk is low, but stable returns you'll get. If you invest your money in small companies, returns could be very, very high, but risk could also be very high. If the fund manager is investing your money basically in, let me tell you, there are two types of investments further, growth and value. You might have seen SBI growth fund. You might have seen SBI value fund. What does these terms means basically? Now, let me show you over here, guys. Now let's open any equity fund, equity large cap. It's not getting opened. Still, we'll try equity large cap direct 1 year. Okay, let's see how it works. Now over here, guys, what would happen? See, let's scroll over here itself. Now equity, where it is? Equity contra. Contra itself means you might have seen that video game Contra, fighting military game. Contra means when the investor is investing in the companies which are on contrary to general public opinion. Means they are going against the herd. They are going against the public opinion. Means they are investing in those companies which other people think it's not good, and they are taking risk. So returns in these equity counter funds are very high. It will touch 20% and it can exceed 20% as well. Dividend yield, guys, it is very important to understand. It's a very important concept over here. There are two types of mutual funds. Type number one is when I am taking money from you and I invested that money and I earned profit. Now I can share that profit to you in terms of dividends. So such kind of mutual funds are called as dividend yielding mutual funds. You will get some dividends basically, right? So that dividend could be in the form of I will give or credit some money to you in your account, or that could be again in the form of some units. I can give some units to you. This is called as dividend yielding mutual funds. There is one more type of mutual fund when I am using that dividend and I am reinvesting that dividend again. So, which mutual fund according to you is better? According to my opinion, the mutual fund which is not giving the dividends, that mutual funds are better because they are reinvesting your profits and they are purchasing more, you can say, stocks from that profit, and your returns will increase. Dividends should not be a criteria for investments. Only capital gain should be a criteria for investments, right? So these are funds who are investing either in the companies who pay a lot of dividend like PSUs and other companies, or there are also mutual funds who pay back the dividends out of profits. So those mutual funds should be avoided because the returns are low. So here it open, guys. These are large cap funds. So you can easily see it is touching 20%, 25, 25, 23% easily. On an average, it is touching. So on an average, it is more around 18%, as I told you, sometimes 16, sometimes 21. So around 18% return you can expect. 18%, 18%, it is generally you can expect this amount of return. The only thing that would come into play over here that it would be a bit risky because these are equity funds and equity funds are risky basically. Now, dividend yielding is finished. ELSS. ELSS are the funds. It is employee linked saving scheme. Means under Section 80C, if you buy these funds, they will help you to, in some tax deductions. You will get some exemption in the tax under Section 80C. So again, there's a limit of 1.5 lakhs. So PPF and these are good way of saving your taxes. So you can invest in ELS. It comes with a lock-in period. Remember, guys, it comes with a lock-in period of 3 years. Those things you have to see. What is the lock-in period? Now, next is flexi cap, large cap, mid cap, multi cap. Large cap means they are investing in big companies. Returns would be less but stable. Mid caps, they are investing in capitalization companies, means the company size would be not big, not small. Returns would be again stable. If they are investing in small cap, it means risk is high. Returns could also be high, but chances of risk is also very, very high. Flexi cap, if they are investing in all types of companies, small cap, mid cap, and such kind of things. Now, equity sectoral. Sectoral means, for example, I am from engineering background. I am from mechanical engineering background. I have good knowledge of manufacturing and production, how it works. And I had worked in environment companies as well, where we used to do environment, water treatments and incineration of the products. So I know what is happening in these sectors. So I have good acumen in these sectors. So if I want to invest, if I want to invest only in these sectors, so I would be investing in these equity thematic. Means now if I buy equity thematic manufacturing, so this mutual fund will be investing my money only in manufacturing sector companies. Similarly, if I buy thematic energy, so this mutual fund would be investing my money only in energy sector companies. So if you have good knowledge of, you can say, banking PSU, so you can invest in PSUs or you can invest in banking sector. So these mutual funds are sectoral, specific, sectoral specific. If you think AI is coming and IT sector is going to boom, so instead of investing in all the journal companies, why don't you invest directly in thematic IT? Thematic information technology, this one, equity sectoral technology. So it means after 10 years, your money will multiply insanely, guys. For example, during COVID crisis, you might have seen pharma companies made huge profits. So if a person who is from pharma sector, having good knowledge of pharma sector, he might have purchased this equity pharma, sectoral pharma healthcare. This sector would have grown. Modi ji, when he got selected as Prime Minister, he said India will grow in infrastructure in good way, like roads, buildings. So if he's giving hints, why don't we invest directly in infrastructure companies? Instead of buying stocks, we can invest in equity sectoral. So these are the funds who invest only in specific sector, guys. So I hope this is clear to everybody. Hybrid funds are the funds who combine equity and debt. So what are the returns you can expect from these hybrid funds? Hybrid funds can give you returns around 12%. 12% to 14% is the range. It starts from 11, 10, 11, 12, 13. This is the range. Means whenever I say 12%, it could be 11, it could be 10, it could be 13, it could be 14. 2 degree plus and minus, you can say. 2 plus and minus. Hybrid aggressive, taking risks. Hybrid arbitrage means buying at one place, selling at another place at higher and lower price. So it's very dynamic. Balanced conservative means taking less risk, equity savings, multiple assets allocation. See, hybrid means they're allocating their funds at multiple places. So I hope this is clear. Index fund is very important. If you don't have knowledge of any of these, if you don't want to take any risk in your life, the best investment would be index fund. More the country will grow, more Nifty 50 will grow, and more this fund will grow. What I want to say, index funds are those funds who invest in top 50 companies of the country. That's it. As simple as that. So index funds are those mutual funds who invest in Nifty 50 companies. Safest option, very less risk. Returns are also optimum, more than around 14% return you can expect from here. So over here, index fund, see 15%, 14%. And guys, these funds have done good as well. Just see over here. Latest funds, see 15%, 20%. So returns are very high, guys. Just see 40% return. These are latest funds actually, 19%. If I say you can expect very high returns in these index funds, means around 18%, 20%, more than 15% returns from these index funds. And these are safe, guys. If you ask, sir, which is the safest amongst all? So this one is safest. Index fund is the safest. Close your eyes and invest over here. If you have a client who takes your advice where to invest your money, advise him to invest in index fund. As simple as that. So guys, we had covered almost all the funds. Now these funds and funds are left. We will be discussing funds and funds in the practical part. We will be covering the practical part as well. Now I hope equity fund, debt fund, and hybrid fund is clear to you, and this riskometer is also clear to you. Now, guys, how you can invest your money. Though we are going to discuss this thing again in the coming classes. Lump sum, SIP, how we can be investing. First of all, dividend payout and dividend reinvestment. We already discussed this, right? Means if I'm being a mutual fund or being a AMC, I am earning profits from your money. I invested the money, I earned profit, and I gave dividend. That dividend could be in the form of cash or in the form of units, anything. This is type 1. Dividend reinvestment mutual fund is good. Means I am not giving you dividends. Whatever profits I am making, I am reinvesting that profit. So always try to invest in this type of fund. Don't in the not in the dividend payout. Because in the dividend payout, guys, your returns will get divided in dividends. Means company will keep giving the dividends to the people. So it's not advisable. Your profits will decrease. So try to focus more and more on earning more and more on income or more and more profits from any investment basically. Direct and indirect mutual fund already covered. Now, what are the ways I can invest in a mutual fund? Now, in this class, I'm going to just give you a glimpse. In next class, I'm going to give you practical implication of all this. Lump sum means if you don't have a, if you want to invest anytime, you don't have hard and fast rule that I will invest every month or something like that. If right now I'm having 10,000 rupees, I will straight away invest in mutual fund. After 6 months, again, I have some 10,000, so I will again invest. Lump sum means you are investing money, as much amount of money, but without with flexibility, without any hesitation that you have to pay every month. SIP means systematic investment plan means now this time you are investing money, but fixed installment every month at every specified interval, just like RD recurring deposit. It is recurring. For example, every month you are paying 500 rupee in a mutual fund. You are paying 100 rupee in a mutual fund, 5,000, 1,000 rupee in a mutual fund. That will automatically get deducted. It is good for students. If you have not started investment yet, it's my instruction, my advice, start investing. Even it is 100 rupees. Start investing from today only. Whatsoever is your age, start as early as possible. It seems like 100 rupees very less today, but keep on increasing that. 500, rupee every month. After 20 years, 30 years, 40 years, you will really thank me, guys. Start as early as possible. Don't think whether you know or you don't know. Just if you don't know anything, just invest in index fund. Nothing. And again, it shouldn't. I'm saying you should put this habit of investing start as young as possible. Now, there is SWP as well, systematic withdrawal plan. This we are going to discuss in the next class, and systematic transfer plan as well. How this can be used. Systematic withdrawal plan means, for example, you are having 1 crore rupee. Now, that 1 crore rupee you invest in a mutual fund under SWP. Now, under SWP, guys, from that 1 crore rupee, that corpus, that principal amount, that will stay untouched and you will get every month income from that. Means the mutual fund will invest at 1 crore rupee somewhere, and whatever profits it will make, it will generate monthly, quarterly, it will give that profits to you. So you will be making profits of that 1 crore, and that 1 crore rupee will stay untouched. So every month income you will be getting. So over here you can see, guys, there are some plans. It's not. So I hope this is clear to everybody. So an STP means, guys, if you are buying and selling mutual funds again and again, means if I'm buying a mutual fund, selling it tomorrow, buying again, selling it again. First, I have to pay brokerage to the company, right? Commissions and expenses. Government also impose taxes on me. So in such kind of things, STP helps. Systematic transfer plans. I purchased a mutual fund for 2 years. Then I transfer that mutual fund to the same company within a same company. It's very important. Within a same company, and I purchased a new mutual fund. So it's not a purchase. It is transfer of the funds from one fund to another. So you saved your taxes, government taxes. Government will think that you are holding the same mutual fund, just it got transferred. Secondly, you can extend your duration. Means if you are investing in a mutual fund for 2 years, 3 years, 5 years, after 5 years you shift your money to a new mutual fund within the same company, HDFC mutual fund within HDFC mutual fund. Now, if the mutual fund was not giving you good returns, you can switch. Secondly, you can increase the duration time without paying the taxes. This can help you to save taxes, guys. I hope this is clear to everybody. Now I wanted to show you this thing. Okay, that's why it was asking login. So I will be showing it tomorrow practical class. Tomorrow we will be doing the practical straight away. Now, guys,